So the three most important points are: you need to have a deck, you need to have a financial model, and also you need to have a lawyer. And not just because I'm a lawyer, but it's very important for you to have a lawyer, and not just a simple corporate lawyer, a lawyer who knows about startups, who knows about financial rounds, who knows what are the standard markets, and to know what are the red lines. Because when you start conversations with investors, it is very important for you to have a person next to you that really knows what are your red lines or not. Because, for example, if you start a financial round with the 3Fs and the 3Fs ask you for a liquidation preference, that's not a standard market. But if you don't know, maybe you will accept it, and that will affect your strategy of the company. So it's very important for you to have a lawyer who can help you during that process. And also during the presentation, we are going to see what are the most important points for you to include in a deck, and also why it's important for you to have a financial model ready for the financial round. Because it's very common when entrepreneurs arrive to Delvy to ask us, why do I need to have a financial model if I haven't started yet my company, or I just have an idea? Because investors are going to ask you, and even if everything are assumptions, it's very important for you to have expectations of the company. So how I'm going to monetize my idea, what are going to be my earnings, and so on. So that are the three most important points. So when a company prepares a financing round, there are three key aspects. So the most common question are what is the perfect moment for a company to start a financial round? I will say the later as you can, but take into consideration that the company is not in a stress situation. Why as later as you can? Because when time goes, you will acquire more valuation. So that's very important for you to have some KPIs, for you to have been proving your product, to have more valuation. So as later as you can to have a greater valuation, but take into consideration that a financing round can take between 3 and 6 months. So we will recommend you to not wait until you have 1 month left of cash in the company to start raising funds, because you will be in a situation not very helpful for you to negotiate with investors. Because if you don't have any cash in your bank account, you will accept all the conditions the investor may ask you. So take into consideration the later as you can, but don't put your company on a stress situation. So take in mind that a financial round will take you between 3 and 6 months. Also, it's very important for you to have the funding requirements very clear. So what's the amount that I need for now and for what period? So we have many entrepreneurs that arrive to Delvy and say, okay, I need 200,000 for 3 years. Take into consideration that it's not very common for you to ask for an amount for a long period of time, because 2 reasons. The first one is because, as I said before, your valuation will be increasing during the year. So we would recommend you to ask some money for a period of 12 to 18 months. And also because as a startup, your company is going to change. So you don't really know what's the amount that you will need during that long period of time. So very important. Take into consideration the amount, the time, and also on what you're going to invest. So it's very important for you to have very clear on what you would like to invest those funds. I would like to increase my marketing strategy. I would like to increase my internalization. So that's very important for you to have it very clear. And also investors to contact. And now that you have entered into the startup world and you are in that kind of situation, you will really know what are the part investors now in the market. So yeah, just take into consideration that are a lot of investors. So just for be clear, you will need to contact investors depending on the situation that your company has. For example, if you are planning your first investment round, you will contact the 3Fs. If you are planning a Series A, you will contact more VCs or big business angels. Also, it's very important regarding the funding requirements that you take into consideration the valuation. The valuation is also a point that is very asked by entrepreneurs, because it's very common for them to ask, what's my valuation? So you need to take into consideration at that point that the valuation, when we're talking about startups, we cannot evaluate the company on a classic ways of valuation, like, for example, can be done by Telefónica or El Corte Inglés, because you are not billing at that moment. So the valuation will be calculated between what's the amount that I really need and what's the percentage that I want to be diluted. Is there a 20%? Is there a 10%? And with that 2 points, you will have your valuation. But also the valuation takes into consideration qualitative matters. For example, the team, what's the stage of the product, MVP, has the company start set to sell or not? Do I have any lead investor who accepts my valuation? So all that points will help for you to defend your valuation. So once we have clear what are the key aspects of the financial bond, we're going to see what are the most important points to be included on your deck. So we will recommend you for the cover of your deck to put all your contact details. So contact information. So all the investors receive a lot of decks. So put them very easy to contact you, to put on the cover your milestones, what you achieve before your financial rounds, any KPIs. So the most important features of the company, include them on the cover. So it's very, very important. Also, we will recommend you to include your highlights on the cover or the second slide. And then the third slide, we will recommend you to include problem, solution, and your strengths. So the point here is, what's the problem that I'm solving with my company? And related to the solution, is that problem affecting to how many people? So you need to take into consideration that even if the problem you are solving is very important for 23 people, investors are going to ask you for your company to be suitable for them to invest. At the end, their activity is to invest in companies who they believe are going to be profitable. So yeah, you need to include what's the people who, what's the magnification of the problem? So, and then what's your solution? What's your solution, and what's the difference between you and your competitors? What's the difference between you? So why your competitors didn't solve that problem? And also, what are your strengths? What's related to your solution and the difference between your competitors and your solution? What are your strengths? And also, following that line, another slide that is very important is for you to include your product highlights. So we also recommend here for you, for example, if you're a marketplace, to include some screenshots of your webpage or your marketplace and how that works. What's the user experience? It's very important for the investors to understand what's the product or the service of the company. So also, if you have any kind of trademark, patent, software, register, it's very important for you to include a slide with the product. And also related to the product, we will recommend you to include some slides with the most important features also, but develop, not just the ones with the bullet points. So for example, if you have started your product, your production, your MVP, try to explain very well that your product or your service has been accepted by some users. For example, if you have some users subscribed to your platform, how many users are those users are paying for those services or not? Also very important to include regarding with the go-to-market strategy and related to the product and sales. It's very important for you to explain how you're going to monetize your company, because it's very important, as I said before, investors are looking for profitable companies. So they are really interested on the financial side. So you need to make clear that you explain really well how are you going to monetize your activity. Because at the end, the financial side is to put with numbers the financial model, I mean the business model. So I have an idea, I have a business model. So at the end, the financial model is to put those business model into numbers. And it's very, very important for you to have it very clear. So what I was saying, what are my strategy with the product? Is this going to be national or international level? How I'm going to scale that product in the market? And also, as I said before, and also related to the evaluation, it is very important for you to explain very well the team. So team at the beginning of the company, and as you have been, everybody will say to you, team is everything. So investors at the first beginning of the company are going to invest you because of the team. So it's very important for you to make very clear on your deck what is going to be the dedication of the team. Is the team going to be on exclusive basis or not? So what will be the dedication? And also, it's very important for you to include the CV of the team. For example, at the end, if I have a CTO that is very, very top in the market, is an ex-Google CTO, so yeah, include it on your deck, because that will be, maybe will be the turnover for the investors to invest on the company. Also, it's very important for you to explain the go-to-market strategy. So how I'm going to see my market share. Is this going to be inbound, outbound, or how the company is planned to go into the market? And also the product roadmap. So yeah, explain how you see that roadmap. And also very important, and what happened with the COVID situation, explain to investors how this situation is going to affect your product roadmap or your sales roadmap. Because we have seen that a lot of companies, tech companies, have increased a lot their activity because of COVID. So explain very well what the impact of the COVID on your company situation. So yeah, at the end, maximize your chances. So team, as explained before. So what are the skills of my team? Explain very well CVs and full-time dedication. Also international tests. So investors are looking for international scalability or national, but with a scalability. So it's very important for you, if you are planning to go international, to include that in your deck. And I said before, the COVID and product adaptation and customer relation. So how my product is going to be adapted to the COVID situation. And also a point that we'll recommend you to include on your deck is when you have been doing your first financial round. So we are talking now about Series A or a not seed financing round, you will have on your cap table some very interesting profiles. For example, some advisors, some investors that can make other investors to invest in your company. So if you have, for example, a top advisor on your cap table, show that. Also, we will talk about legal aspects later, but if you have a shareholders agreement, put also that in place. And also, it's very important for you, if you have any kind of social impact, to include that on your deck presentation. So, for example, is your company helping with social impact regarding, social, I don't know, for example, you are helping other people to be introduced to the market and so on. So at the end, you need to include all the features that will just, as the slide said, maximize your chances to be invested by investors. So put all the information that can be the difference between other companies to be invested by them. So here is you will receive that presentation, but for you to have more or less clear what's the documentation that we will recommend you to send to investors, for them to have very clear what's your structure and your strategy of the company. It's performance indicators, product definition, as I said before, go-to-market plan, business plan, corporate structure, and financial model. So it's very important for you to have all that documentation very clear. And when you send that to the investors, obviously investors are going to ask you for more detail or any kind of proofs and so on. But if you have everything very clear, so yeah, you will help them to decide to invest in your company. So, and then the last point that I said before is a moments, requirements, and also to choose the right investor. So yeah, depending on the situation of the company, the sector, and the financing round that you are planning, you will go to look for some kind of investor or other. So you need to have very clear all the financial requirements, what's the current situation of the company, did you start your activity, what kind of activity have you started? Because depending on that, you will go to some investors or others. Also, the valuation is very important for you to go to some investors or others, because our VCs, there are just investors from 1 million to above. So, depending on the situation of the company, you will need, you will go to some investors to other. So aspects to take into consideration: sector, the amount of money you're requiring, also the vision and the investor may have. Also, it's very important that I said before that you take into consideration when negotiating with investors the time. So what's the time? If you need cash in 3 or 6 months or not. So at the end, cash is king at that point, and that will help you when negotiating with investors. So after that, we're going to go to legal aspects. So I don't know if you prefer to ask any questions on financial aspect now, or I will go to legal aspects and then go to questions. I don't know what.
Anyone has a question at this moment? Okay, we can continue then.
Okay. So once we have everything clear regarding financial, so we have everything prepared for us to go to seek some finance, the hard part arrives. So that's the negotiation. So yeah, that at that stage, and as I said before, there are 3 kinds of types of shareholders agreement, depending on the stage the company is. So we have 3 stages: seed, early, and growth. So depending on the stage, we will include some clauses or not on your shareholders agreement. So on the first seed stage, will be between the shareholders agreement, will be between founders. So what we will recommend you for you to regulate on that shareholders agreement is positions and activity of the founders, the vesting, what's the activity, what activities are going to provide those founders, in what basis, exclusivity or not. Also, what will be the equity split between founders? So is one founder is going to have 50%, the other 50, or any kind of percentage? Also, it's very important for you to trust on the other founder to have a vesting of shares that I will explain you later, and also protection clauses that I also will explain later. When we arrive to an early stage, we will start negotiations with the 3Fs and also with business angels, investors. So here we will recommend you to include also dedication and permanence, and also the control clauses that we will explain you also later. And then we have the growth stage. And that stage is very normal for you to receive a term sheet with all the conditions of the financing round. So at that point, once you receive the term sheet, we will recommend you to contact a lawyer, because what we have seen that happens a lot is that you receive a term sheet and you think that those conditions are market conditions, you accept those conditions, and then when you put a lawyer in place, problems start, because you have accept some clauses that were not market standard, and then it's very difficult for lawyers to discuss with investors those clauses. And also at that stage, economic clauses are included on the shareholders agreement. So what we also recommend you for entrepreneurs is to prepare a shareholders agreement that will go with you during all the stages of the company. So if you prepare a really good shareholders agreement at the beginning of the company, it will help you with financing rounds. And also it's very important for you to take into consideration for future financing rounds that it's very important for you to don't accept clauses that are not really market standard at one stage or another. So as I said before, for example, if the 3Fs ask you for a liquidation preference, is not market standard, and for example, in what that will affect you is that when you go to growth stage, investors, VCs, are going to ask you for 3 or 2 times that liquidation preference. So yeah, because at the end, when you start growing the company, and VCs and more professionals, investors, are going to ask you for more rights than the existing investors used to have. So yeah, just remember, it's very important for you to remember from that, from my presentation, to make very clear that you don't accept clauses and conditions that are not really market standard at this stage of the company. So yeah, I'm going to talk about the governance clauses, the economic and the control clauses. So I don't know if you may really know or not, but the companies have two organs: the shareholders meeting and the governing body. So there are 2 bodies in the company. The first body, the governing body, can be organized by a sole director, joint and several directors. That mean that directors need to act together, or joint directors. That means that any director can act on behalf of the company, even if they are 2. Also, the company can be governed by a board of directors. We will recommend you, regarding the board of directors, to put that in place on a growth stage. So the problem with the governing body of the company is that the higher this, the bigger the structure is, the most expensive it is. So take into consideration that we will recommend you at first stage of the company to keep the control of the company, and to try to have and to keep the control of the governing body. So yeah, just for you to know, try to keep the sole joint several or joint directors as longer as you can. Also, regarding the shareholders, in the governing body of the company, day-to-day decisions are made. For example, if you need to ask for a credit with any kind of bank, if you want to hire or fire some employees or service providers, any kind of decision on a day-to-day basis, that's under the governing body. But we also have the shareholders meeting. So all the important decisions regarding the shareholders, for example, any kind of capital increase, capital reduction, or any kind of merger or acquisition, or for example, the approval of the annual accounts of the company, that needs to be approved under the shareholders meeting. Also, the most important clauses regarding the governance clauses are the better rights, reinforced majorities. That means that investors, when enter into your company, they are going to have a small piece of your company, and so you as founders will have the majority of the company, but they are going to ask you to have veto rights or reinforced majority. That means that for the approval of some decisions, you will need the consent of that investors. What we recommend you at that point is for you to try to not give some veto rights. Instead of that, give some majority rights. So for example, if you are planning to that financial round and you receive a term sheet with a veto right, try to modify that for a majority of the investors reinforced majority. That means that you will need just the majority of the investors, the investor rights, the investor vote. So that means that the decisions of the company will not be under the power of just one investor. Instead of that, will be divided into more than one, and that's very helpful for the companies, because if you have any kind of problem with that investor, you will have a problem, and that can block the situation and the activity of the company. So we would recommend you to try to divide that reinforced majorities, and in both bodies, shareholders meeting and also the governing body. So try to keep the majority also in the board of directors. When an investor asks you for a board of directors, please keep in mind that we will recommend you always to keep the majority. So for example, if the board of directors is managed by 3 directors, 2 of them should be appointed by founders and the other by the investor. So you can keep doing the activity without the consent and without the majority of the investor. So here we have also protection, control, and economic clauses. What are the most common protection clauses? As I said before, protection clauses are related to, investors, when investing in your company, they will need some protection, because as I said before, at the beginning of the company, investors are investing in the team. So they are going to ask you for a reverse vesting. How does work? Reverse vesting is that you have for example, 10 shares of the company. So our vesting will mean that investors are going to ask you to stay in the company about from 24 to 48 months. So every year, 12, you are going to vest some shares. So for example, if you leave the first year, you are going to lose, for example, 1% of your shares. And depending also on the way you are leaving the company. For example, if the company fires you, you are going to have a conditions because that's a good leaver. But in the event you leave the company without any reason, that will be considered as a bad leaver, and maybe you will lose all your shares. So take into consideration that investors are going to ask you for vesting. Also, investors are going to ask you for a permanence and dedication on the company, because at the end is what I said before. So the companies at the beginning are just a team. So they are going to ask you for you to be full-time on the company. And please take into consideration that when a lot of entrepreneurs arrive to Delvy, they are very concerned about salaries. So at the end, it's very important. I mean, maybe not at the beginning of the company, but at the end, all people need money to survive. So you will need to take into consideration and to include your salaries on the financial model. So just for you to have it very clear that, I mean, obviously investors won't like if you put your salary very high, but they will appreciate if in your financial model, your salary on a long-term basis is included, because as I said before, at the end, everybody needs money to survive. Everybody has bills to pay. So also protection clauses are related to non-competition and confidentiality clauses. At the end, investors are going to ask you for non-competition clauses. So if you have a soap a company that is dedicated, I mean, for example, if you are the CEO of Globo and then you leave Globo, investors are going to ask you to not open Globo Dos when you leave the company. So that's very important. Also, related to the non-competition clauses, it's very important for you to define very well the project of the company, because at the end, non-competition clauses are related to the activity of the company. So the most well-defined is the purpose of the project, the better for you, because at the end, you will have everything very clear. So what you can do when you leave the company or you cannot. Also, it's very important to have all the intellectual property registered, because at the end, investors are going to ask you to have everything under the umbrella of the company. So it's very, very common for entrepreneurs when they start the company to have, I mean, I'm going to register my trademark under my personal name or my domain and so on. Investors are going to ask you to transfer all the intellectual property under the umbrella of the company. And also protection clauses here are phantom spool. I don't know if you have ever listened about phantom shares. I will go to explain it a little bit extensive way later. So also the control clauses that I explained before is the governing body, the veto rights, and also the description and duties of the positions of the founders and the worker shareholders. And also a way to control control the company is by the control of transfer of shares. So it is very common for you to have a lockup period in which founders are not able to transfer their shares. And the most common clauses are the economic clauses, the exit at the end. What investors are looking for is for money at the end. So they are going to ask you for the typical clauses of drag along, tag along, liquidation preference, anti-dilution, and deadlock situations and dividends. So I'm going to explain a little bit about that clauses. Maybe you have, I mean, maybe you know how they work, but it's very important for us now to refresh the concepts. So drag along at the end is the right the majority of the shareholders have to drag the minority shareholders in the event those majority shareholders receive an offer to sell the 100% of the company. So that will help you to sell the company in the event you receive an offer. Tag along is a right of the minority investors. So in the event normally founders sell their shares, they are going to ask you to sell their shares together with your shares. So in the event you sell your shares, you will not be able to transfer 100% of your shares. Instead of that, some of shares on the minority investors that are willing to transfer their shares will be sold with you. And also liquidation preference, that I said before, liquidation preference is the right that have the investors to receive X times the amount they have invested on your company. So at the end, what is standard market is one time the investment they have done. So it's very important for you to have very clear that it's not very common that they ask for higher time than one. And also it's very important that you have very clear that it's not very common for them to ask you to go with the liquidation preference and with the non-liquidation preference. I mean, for example, I put you with numbers that will be easier to understand. If investors have made an investment of 1 million and you sell the company for 3 million, investor will have the right to receive the first million. So what we will recommend is to accept that 1 million, but not accept 2 million or 3 million. And also to accept that they have the right to go with the liquidation preference and then to have the right to go with the percentage of the company. So to receive the first million and then to go with the percentage they may have in the company. And also the anti-dilution right is also very common. So investors are going to ask you for the valuation to go higher and higher and higher. So in the event you for example, if investors have paid a price of 4 euros and then you raise more money for a price per share of 3 euros, they are going to have the right for you or the company to compensate them by the difference between the 3 and the 4. So for them to receive the shares that they will receive in the event they will invest paying 3 euros instead of 4. And also deadlock situations, they are going to ask you in the event there is a deadlock situation in the company. And then they are going to ask you the politics on how dividends are going to be, how the company is going to share dividends with the shareholders. So also when talking with investors, it's very important for you to have very clear the concepts, the words that I'm going to explain to you now, because what we see a lot is that entrepreneurs negotiate the funding rounds with the post-money valuation. And it's very important for you to take into consideration that all the percentages that you may negotiate should be done on a pre-money valuation basis. Why? Because if you are negotiating a percentage on a post-money valuation, what can happen is that in the event of an oversubscription, your pre-money valuation will be diluted. So your shareholders would be diluted on a higher basis, because at the end, for example, you're saying, I'm going to have a post-money valuation of 3 million after an investment of 200,000. But at the end, if you have a 500,000 investment, your valuation instead of 2.8 will be 2.5. So that's going to be not very helpful for you. So you're going to be diluted. And also you will have listened maybe concepts that convertible notes, participation, loans, and capital base. So at the end, convertible or convertible participation loans is a mechanism that helps companies raise some funds. For example, if I'm planning to go for a funding round, for example, next year, but I need some cash now, I can negotiate with some investors to put me the money now. So when I go to the funding, to the big capital raise, that convertibles will be converted into shares, but with a discount. So that helps me to have some funds and to arrive to the negotiation with the lead investors in a really good, I mean, with a cash position better than in the event that I would never sign a convertible note. So also a concept that you need to take into consideration is the term sheet. During the first investment rounds, I mean, term sheets are not very common, but when you go with big investors, they are going to send you the conditions of the investment. So yeah, as I said before, that will include what's the amount investors are going to invest, also if they need any kind of protection or economic clauses. So at that point, go to review that with a lawyer. And also a point that is very important for you as entrepreneurs to have very clear is phantom shares. So as you may know, in Spain, stock options are not very common because of tax matters. And we use phantom shares. Phantom shares at the end is the economical bite on phantoms that don't exist, but are included on a fully diluted basis of the cap table. So that means that when an investor investing on the company, you will need to take into consideration that phantom shares, but at the end, that shares have no voting rights, and that shares that the people, the beneficiaries of that phantom shares don't need to sign any kind of shareholders agreement. So they just have an economic advice in the event the company is, for example, goes to an IPO or the company is sold in the future. At the end, is an economical bite on the shares of the company. So it's very important here for you to take into consideration that at the first beginning of the company, when you are talking with very top profiles, that you offer, instead of shares of the company, phantom shares. Why? Because at the end, for example, if it's a very, very top CDO, that person is going to ask you for an equity of the company. But for example, at the first beginning of the company, you will start conversations with advisors or people that may help you with the development of the company. But such profiles are not, as good as to give them shares. But instead of that, you can offer them phantoms. At the end, is an economic bite in the event the company goes well. So yeah, take into consideration that we have seen many times that founders offer a lot of shares at the beginning of the company. So when they start doing financing rounds, they see the equity on the company very diluted. So just for you to take that into consideration. Also, another point that you will see a lot when you go to growth stage financing rounds is representations and warranties. So once the company has started the activity, so you have been doing some financing rounds, so you go to VCs. VCs are going to ask you that, the company has everything in order. You are presenting your accounts, all the intellectual property registered, and so on. And also, another aspect that you need to take into consideration that is very important when you are planning a financial round, that not everything needs to be under the financing in equity. So you can complement your financing round with subsidies and bank financing. So here you have an example of the equity and what's the amount, how the numbers work. So you can review it later once you receive the presentation. So, and as I said before, and regarding the legal aspects, when you go to a financial round, it's very important for you to take into consideration that all the intellectual property in software is clear, because not at the first beginning, but at the end, I mean, in a growth stage financial rounds, investors are going to ask you for representation and warranties regarding intellectual property, on data protection, and so on. So we would recommend you to have everything very clear and registered and in order, I mean, from the first beginning of the company. So once you go to raise some funds, you have everything ready to receive such funds. And yeah, that's almost everything.